What is debt to income ratio, your DTI? Debt to income ratio is what lenders will base their decision on whether or not to loan you money for your home, right? Hey guys, I'm John from ListMe Realty Group, and today we are going to discuss what the debt to income ratio is and how lenders loan based on those numbers, right? So as always, I'm not an attorney, I'm not a financial advisor, I'm not pretending to be. I'm just simply providing you with some useful information to help you better understand what the DTI is, your debt to income ratio. So this video is going to be a little bit longer than usual because I'm going to break things down. I'm going to explain them and give you a few examples. So if you want to grab a pen and a paper, maybe jot this down, some of the math part of this to help you better understand. Maybe you're like me. I respond better to somebody explaining it to me in a video than having to read it and figure it out on myself. So here we go. Your debt to income ratio is a percentage that tells lenders how much money you spend versus how much money you have coming into your household. You can calculate your DTI by adding up your monthly minimum debt payments and dividing it by your monthly pre-tax income. When you apply for a mortgage, you'll need to meet the maximum DTI requirement so your lender knows you're not taking on more debt than you can handle. Lenders prefer borrowers with a lower DTI because that indicates less risk that you'll default on your loan. So your lender will look at two different types of DTI during the mortgage process: front-end DTI, back-end DTI, right? So what is front-end DTI? Front-end DTI only includes housing-related expenses. This is calculated using your future monthly mortgage payments, including property taxes and homeowners insurance. So what is the back-end DTI? The back-end DTI includes all of your minimum required monthly payment debts. In addition to housing-related expenses, back-end DTIs include any required minimum monthly payments your lender finds on your credit report. That includes things like credit cards, student loans, auto loans, personal loans, things of that nature. Your back-end DTI is the number that most lenders focus on because it gives them a more accurate and complete picture of your monthly spending. So how to calculate your debt to income ratio. So let's go over this really quick. To calculate your DTI, add together all your monthly debts, then divide them by your total gross household income, right? We're going to use some numbers to illustrate this, right? So add up your monthly payments, then let me restart that. Add up your minimum monthly payments. The only monthly payments you should include in your DTI calculation are those that are regular, required, and reoccurring. Remember to use your minimum payments, not the amount, not your account balance or the amount you typically pay. For example, if you have a $10,000 student loan with a maximum monthly payment of, with a minimum monthly payment of $200, you should only include the $200 minimum payment when you calculate your DTI. Here are some examples of debts that you are typically going to include in your DTI. So first I'm going to say what you should include, and then I'm going to say what you shouldn't include. What you should include is your rent or monthly mortgage payment, your homeowner's insurance premium, any homeowners association fees that are paid monthly, any auto loan payments, student loan payments, child support or alimony payments, credit card payments, personal loans. Things that you should leave out are utility costs, health insurance premiums, transportation costs, savings account contributions, 401k, IRA contributions, entertainment, food, clothing, things like that. So I'm going to break this down and I'm going to give you an example on how to properly calculate your DTI. Giving you an example of some numbers, right? These numbers don't necessarily apply to you. I'm just plugging in some numbers to give you an idea of how to calculate this, right? So let's assume your rent is $500. Let's assume your student loan minimum payment is $125. Let's assume your credit card minimum monthly payment is $100. And then let's assume you have an auto payment with a minimum payment of $175, right? So in this case, you would add $500 plus $125 plus $100 plus $175 for a total of $900 in minimum monthly payments, right? You would then divide your monthly payments by your gross monthly income. and that is the total amount of pre-tax income you earn each month. So when you divide that, make sure it's your pre-tax income. Whether you should include anyone else's income in this calculation depends on who's going to be on the loan. So if your spouse is going to be applying with you, you have to include their information in the DTI. If someone else is applying with you, then you should factor their income as well as their debts into the calculation. Once you've determined the total gross monthly income for everyone on the loan, simply divide the total of your monthly payments by your gross monthly income. So convert the result to a percentage resulting in the decimal. To see your DTI percentage, multiply that by 100. In this example, let's say your monthly gross household income is $3,000. What you're going to do is you're going to divide $900 by $3,000 to get 0.30. Then multiply that by 100 to get 30. That means your debt to income ratio is 30%. So what is a good debt to income ratio to get a mortgage? Now, that is going to vary depending on what loans you get, but the lower your DTI, the better it is in most cases. So let me go through some of the loans and what they require, and discuss your DTI as it applies to each loan and what their requirements are, right? So FHA loans are mortgage-backed loans by the U.S. Federal Housing Administration. FHA loans have more lenient credit score requirements, and the maximum DTI for FHA loans is 57%, although it's lower in some cases. USDA loans can only be used to buy and refinance homes in eligible rural areas. To get a USDA loan, you must have a DTI of less than 41%. VA loans. VA loans, which are insured by the Department of Veterans Affairs, offer a low-cost way for current and former armed forces to buy a home. VA loans do not require a down payment, and they often have more lenient debt-to-income requirements. You can get a VA loan with a debt-to-income of up to 60% in some cases. Conventional loans, there's not a single set of requirements for conventional loans, so the DTI requirement will depend on your personal situation and the exact loan you're applying for. However, you'll generally need a DTI of 50% or less to qualify for a conventional loan. So if your DTI is high and you're trying to figure out some ways that you can get this lower before you start applying for loans in your home searching process, let's start with paying off some small debts, right? The fastest way to lower your debt to income ratio is to eliminate monthly payments, right? With credit cards, student loans, things like that. If you can afford it, right? Pay off your smallest outstanding debt in full, and then, start doing that as you can. As money's coming in, you're paying off these debts and your DTI is decreasing. You can always raise your income, right? Adding a side hustle or picking up a few more hours at your current job or freelancing can offer some cash injection to lower your DTI, right? The more you make, if you keep the same expenses, then your DTI will get lower. Putting another person on the loan will also decrease it as long as their debt to income ratio is lower than yours, right? So let's go over the bottom line of this, right? Your debt to income ratio is how much you pay in debts each month compared to your gross monthly income. This is a key factor when it comes to qualifying you for a mortgage. Your DTI helps lenders gauge how risky you are as a buyer. A DTI of 50% or less will give you the most options when you're trying to qualify for a mortgage. So, guys, that is just a quick rundown, a quick summarization of what the DTI is. I know that video is a lot longer than usual. I tried to explain it as best as I can. So if you have any questions, comments, concerns, or anything like that, you can always email us at info@listmerealtygroup.com, or you can find us at listmerealtygroup.com, which will be in the link in the description, or you can find us on Facebook at ListMe Realty Group LLC. If you find us on Facebook, please like us, follow us, Share us, comment, and DM us if you have any questions. As always, we're here to provide as much information and knowledge as possible. We're here to educate you. After all, knowledge is power, and we want you to have as much of it as possible. So if you use us or you don't use us, this is always useful information. Like I said, I'm not an attorney or financial advisor. I'm simply providing you some useful information. So guys, until the next video, have a good day.